Hey guys, Venk Ramkumar again. Um, I know it's been a while since I made a video, but it's good to see you guys again. Today is September 17th, 2022, and this is going to be my fourth video for financial analysis. So I hope you guys will enjoy it. Um, it's going to be a little different this time, now that we're 9 months into the year, and I've already made three videos breaking down companies. I thought I'd switch it up this time and just talk about general macroeconomics, just general business based off of my knowledge and my experience. If you guys don't know, and if this is the first video you've seen by me, go and check out my other three financial analysis videos where I break down, where I show proof screenshots of all the companies I'm invested in and obviously the performance and everything, but I've also taken three of those so far and done a cash flow analysis, earnings analysis. But I just want to talk about in this video a bunch of things that are on my mind, just about economics, macroeconomics, future plans, how I want to go about my business endeavors. So I really look forward to showing you guys, and I am going to give you guys an update on my portfolio before I go into it. Uh, so I'm gonna give you guys just a general overview. So like I said, this is not going to be a financial analysis video, but it's going to be just my general thoughts on macroeconomics based off of my experience in investing. Once again, I want to give you guys an update. And as you guys know, if you guys have Merrill Edge, you will know that these are screenshots that you can get from the account performance. Like I said in my last video, I'm only going to go back 1 year from now onwards because in my first and second video, I've given you guys my whole investing performance compared to the index. Right here, it's the NASDAQ on top and the S&P 500 on the bottom, comparing it. The blue is mine, and I believe that's orange, is the indices. So as you can see, the last year has been good for me. It's been a little tough for the indices for reasons that I'm going to talk about in this video. But if you guys want to see a full breakdown of each company, once again, please go to my first video where I give you guys every single company I'm invested in. And obviously the three videos after that, two videos after that, I've been telling you guys what I've been adding and what I've not, and where I've been adding them. So the first thing that um, I want to talk about in this video is current market dynamics and why um, there's a lot of noise out there with, get into this sector, get into that sector. And I want to just talk about what I kind of do to filter out the noise, whether it's from, the doomsday preppers or the CNBC telling you to, switch your portfolio every back and forth. As you guys know, I work as a financial analyst. That's my day job, obviously. I'm obviously trying to become an entrepreneur, but right now I'm still working 9 to 5 financial analyst. So I'm able to understand business as well. But as you guys know, my investing philosophy has always been in cash flowing companies that are raising dividends, dividend growth investing. What that means is companies that are growing their earnings per share 5, 10, 15% year after year after year, but that also pay out earnings the dividends that are growing, 5, 10, 15% every single year. Usually these kind of companies are companies that people cannot live without, right? So as you know, I invest in some of my biggest holdings are AbbVie, which is a biopharmaceutical. Lockheed Martin is a defense contractor. Cisco is a network provider for Wi-Fi and network communications. Merck, that's another pharmaceutical. Um, I'm just trying to think back. L3Harris, that's another defense contractor. Procter and Gamble, that's just everyday usage. Kimberly-Clark is another one. They do items that people use every day. Altria is a tobacco company, and believe it or not, Altria is the best performing company in the last 50 years, right? And other dividend growth companies that have uh, companies that can be in tech, like Cisco, can be in biopharmaceuticals, can be in defense. These industries are all growing. They're growing 5, 10, 15% year after year. And usually what happens in times like we're in right now is obviously you see for the last 14 years, ever since the 2008 crisis, the Federal Reserve was lowered interest rates down to 0%, right? So basically what this means is if you go to a bank and even bank to bank lending, banks can get funding in companies. Now I'm looking at this from a company perspective, right? If a company wants to grow and they want additional funding, they're going to be able to go to a bank and get a very low interest rate for loans, so which means that they can expand, right? So what happens for companies, for example, that do not have much earnings, right? Of course, they can get investor funding, but a lot of times they can also get loans from banks to do different ventures, right? So this allows companies that don't have earnings right now, it allows them to grow. It allows them to get easy funding, either from banks or some kind of loan, people that are trying to give them funding at a low interest rate, right? Cash flowing companies, while they can take on debt, it's less important for them that it's a low interest rate, because even if it's a high interest rate, a lot of times they're going to be able to pay back that debt because of their cash flow that they have from their earnings. So right now, what's happening obviously is that interest rates are rising, which means that it's even more important that a company has strong cash flow, which is why right now a portfolio like mine, which is made up of strong companies that have very good earnings coverages, low payout rate, decent payout ratios. If you don't know what these mean, go back to my last few videos. But it's more important than now. That's why you see a lot of value companies rising. Their stock prices are holding up decently well, and they're actually raising dividends. The main reason for this is because, and a lot of growth is getting hit hard, right? The reason for this is obviously because the cheap money is drying up. Interest rates are, I think, now at 2.5%, 3%. But a lot of times the loans for these companies are not actually 2.5%, 3%. They're actually higher than that. They're actually, just because the federal funds rate is 3% does not mean a company is going to get a loan from a bank at 3%. It's probably going to be 5% or 6%. So that's why right now a lot of these cash flowing companies are doing well. Another reason why it's doing well is kind of a double whammy. Growth versus companies that have solid earnings right now is the second reason why is because obviously inflation, right? Inflation's running at 8.5%, 9, 10%, which means that, for example, if you had a business and you are investing back into the let's say the business is not really making any money right now, but you expect the business to make money in 10 years. Well, if inflation's 8, 9%, you want to see earnings now, right? Because by the time 10 years goes down the road and this company starts to grow and actually produce earnings, inflation could have eaten away at the valuation of the company, and you're not, like, just for a company to pay its normal operations and upkeep, that's going to be trouble because the wages have to go up, right? Raw materials have to go up. If a company is investing or needs networking technology like routers and stuff all across its many different facilities, the price of those are going to go up as well, because all these things are kind of like commodities. So that's a reason why a company that has strong cash flows is returning capital and earnings back to its investors. Those companies are rising in value, or at least keeping up with inflation, and they're not getting hit hard in this market correction because they have earnings now. Investors want earnings now when inflation's high. So I've always told you guys, right, not to take unnecessary gambles with companies that are not actually don't actually have earnings. For example, that's why the S&P 500 is getting hit really hard right now, because in the last 10 years, the S&P 500 has been really skewed to technology. In 2008, the biggest company in the world was, I believe, Exxon was one of the biggest companies in the world. Right now, the biggest companies in the world are all tech with very, very high multiples, right? Very high multiples, 30 PE, 40 PE. So what happens when, like I just explained to you guys, when growth gets hit, people want earnings now. A lot of those tech companies are getting hit, which is why you see the S&P 500, even though it's made up of 500 companies, the largest valued companies are tech and in high growth industries. And right now they're getting hit hard, which means that the S&P 500 is now down a bit, 20%. The NASDAQ is even more. It's only a tech index, which means the Nasdaq. That's why you see the Nasdaq hit 30% versus the S&P is only 20%, and you see the Dow, I believe, is only down 15% because the Dow has industrials and cash cow companies that are actually producing earnings. That's why the Dow is the one that's holding up the best. So what do I recommend you guys do? I actually do think at some point it's going to be a good time to start buying growth, and I'm going to tell you guys what there's one company I'm starting to nibble right now as it gets good, because you want to buy growth. You do want to actually buy growth. You don't want to completely neglect growth, right? But you don't want to buy growth when interest rates are low. There's extremely high optimism. That's like you're just going with the crowd. You want to go against the crowd. So right now, there's a company that I'm buying. I'll tell you guys what it is. But I'm buying it now because I'm starting to buy into it because its growth is very cyclical, right? A lot of these companies, and right now we're kind of on a downturn. So I'm going to keep buying, but I do expect it to go lower. But yeah, guys, I still continue to buy companies that are, producing dividends back to me because obviously I want to get paid. I want cash flow coming back into me right now. So that's what I recommend you guys do, is to stay with companies that are producing strong earnings. Like the last three videos, I've done analysis on companies that are strong earnings. So if you guys want any ideas on what are some strong cash flowing companies and where I'm buying them, watch my last three videos. So this is kind of another thing, right? People ask me all the time, how do you keep track of all your companies? I just have a watch list basically. So I'll do my analysis on each company and then I'll put it in a watch list. And it's funny because a lot of times different companies will get hit in the different time periods, right? Like for example, 2 or 3 weeks ago, or a month or two ago, Cisco got hit hard. Cisco was already on my watch list. But when it got hit 12, 13%, I did another analysis on it right after it got hit 12, 13%. And one day I did the analysis for you guys, and that was already on my watch list. But I'll have about 10 or 15 companies on my watch list, right? And every time I have excess capital in my life, I mean, obviously, I'm continuing to do analysis on these companies, a quick analysis after I've done my overall analysis, but I'll keep about 10 to 15 companies. And as these different companies fluctuate up and down in value, as some of these companies are going up and the other ones are going down, the other ones are going up, the yields of those companies are probably going higher. So then I'm allocating capital into the companies that are on my watch list that have gotten hit, right? So that's an easy way to do it, guys. And obviously, I'm kind of doing half the work for you because every week I'm coming out with a new company and doing my full analysis on it. So you guys can just add these companies to your watch list as I do the analysis on them. So, yep. Okay. Next thing I want to talk about is why am I interested in the stock market? Uh, is that the only way to make money? Is that where I see myself going in the future? Half and half. That's a yes. That's both a yes and no. First of all, why am I interested in the stock market? The stock market is a really great way to learn, to start understanding how companies are valued, because all the information is public, right? For example, in real estate, you've really got to uh, it's not all public information. You've got to do a lot more work, and that's a good thing, but you've got to do a lot more work in terms of, going to each neighborhood and figuring out, and you have to meet with the banks, and you have to maybe even meet with real estate maintenance companies, people who look after your property and all that. I do want to do that in the future, but right now, the stock market is great because it gives you an overall understanding of how business works, right? Like I've been talking to you guys about, it's very easy to see what the PE ratios are, what the analyst expectations of future earnings are, what the past few earnings are, what the payout ratio of these companies are, how much a company is earning, and how much of those earnings the company is paying out to dividends to shareholders. What the last 10 years of growth has been for the company, earnings per share, diluted earnings per share. You get to see the revenue growth. You get to see what PE the company has traded at in the past. You get to see how if the company cut its dividend during recessions, 2020, 2008. Right now we're in a recession, 2020, 2008, 2001. You get all this information, you get to learn business. So you don't even have to take classes in college. You don't even have to go to college. You can just learn through YouTube videos, which is pretty much what I did. I am actually an engineer. That's my bachelor's is in engineering, but I started learning about investments and finance. And obviously, since I had a pretty good math background, it was easy for me to do that. So I really recommend you guys to at least start with the stock market, right? Even if you're just investing in an index fund, just play around with different companies and see, okay, like what are the different valuation metrics that I talked about, right? And I'm continuing to do that today. Yeah, so like I said, my plan is to get into real estate. And I'm going to also talk about this next uh, slide right here while I talk about plan to get into real estate. So why do I plan to get into real estate? Yes, I do. Right now I live in, I don't want to say exactly where I live, but I live in a good state that's very, very good for real estate. Um, what I mean by that is it allows entrepreneurs it has a strong economy. For example, in 2020, the unemployment only went up to about 6%. The GDP only dropped 2%. That's a very big difference compared to the whole United States. But why do I want to get into real estate? Well, because you can use debt versus using cash, debt versus equity. So when you invest in the stock market, for example, you're basically trading $1 of your capital for $1 equity kind of in the company. Um, so what this means is you have to save up, right? $100, $200, $1,000, $100,000 in order to deploy. If you deploy $100,000, you've got $100,000 invested now in a company. So if you want to invest $100,000 in Apple, you got to save up $100,000, which means that after you save up 100,000, you can now invest 100,000. You get $100,000 worth of equity, percentage stake, whatever the 100,000 over the total market cap. You get a certain percentage stake in Apple. Well, what the good thing about real estate is that you get to use debt, right? So why is this good? Well, let's say, for example, you have a company that has a PE ratio of 10. I'm talking about the stock market right now, which means that the PE is the price of the stock over earnings is the PE ratio, which means that if the stock is worth $100 per share, it's earning $10. It's going to take you about um, 10 years to get your initial investment back, assuming that the company does not grow its earnings, right? So PE is 100 over 10. If there's a 10 PE ratio, it means it's going to take you 10 years of earnings to get back your initial $100 worth of investment. Well, the beauty in real estate is, let's say you use the same $100. Let's say instead of investing $100,000 that you would have in the stock market, you take the same 100,000 and you invest it and you go to a bank, and the bank gives you a $900,000 worth of debt, right, to buy a $1 million property. That $1 million property, now it's got to be a cash flowing property. I'm not talking about a personal house. I'm talking about cash flow. So let's say you buy a 10-unit apartment condo for $1 million, or maybe a 5-unit, let's say, for $1 million, and you got $100,000 of your own money, and you've got, let's say, a 900,000 of the bank's money. So you buy the $1 million property. Well, let's say the $1 million property, after you pay the mortgage, you pay the taxes, you pay maintenance, upkeep, homeowners insurance, and all this, you make 5% of the total value of the property back in earnings. Okay. So let's say if it's a $1 million property, you make $50,000 of earnings every year after you gross profit, after you pay, like I said, all these upkeep, mortgage, interest, taxes, all these things, right? Well, the beauty here is that instead of the stock market where you could have gotten, off $100,000 investment, you get $10,000 back, gives you 10 years to make back your initial investment. Well, with real estate, if you get the whole property, but you've only put in 100,000, which means that now if the whole property produces only 5%, well, that's a 50% return on your investment because you only put in 100,000 and you're getting back 50,000 year one. So it only takes you 2 years at that point to make your initial investment back. Now, obviously, I'm simplifying it, but what I'm saying is, even if the property only returned 1% earnings, that would pretty much match the stock market. And a lot of real estate investors can do much better than 1%. So the true wealth is actually made in real estate, which is why, like I said, I'm learning about business, learning about finance, like I show you guys every week with the breakdowns within within the stock market. But at some point within the next 1 to 2 years, I hope to get into real estate for this reason. This is how the true business entrepreneurs make the real money. They don't invest it in the stock market. They actually use banks' leverage to use a bank's leverage in order to amplify their returns. So I hope to do that in the future. Right. So another positive about real estate, right, is that once you learn how the stock market works, once you learn how companies work, how you value a company, which is going to be very useful when you're looking for a property in terms of earnings and payout ratios and how much a company's paying in interest and how much, right? I talked about, if you like go back to my video on Merck, I broke down exactly how Merck is paying out its interest, how much money has left over, what free cash flow means. This is all very important in real estate. But once you do that, what happens in real estate is that, let's say you buy a $1 million property with $100,000 down payment, and you get a 9-to-1 leverage rate. You get a 9-to-1 leverage with a bank, right? So a bank gives you 900,000. You put in 100,000. Well, what happens in real estate is now let's say you can meet with the bank. You have the bank's associate there, but you can also meet with apartment maintenance, apartment upkeep companies in the area, maybe a lawn care company in the area. Uh, um, you know, you can create jobs because now you can work with all these people, and all these people actually want your business to do well. The bank wants your business to do well because as you collect earning, as you make good cash flow on the property, they're going to get interest on the loan, right? And they're going to get their loans paid back along with interest. So the bank really wants you to succeed. Another thing is that when you the apartment companies that do the maintenance and they take care of the rent and everything, if you have a big enough deal, what happens is a lot of these companies also want you to succeed, right? Because you're basically working as a team at that point because they want your business. If your apartment goes bankrupt, or you as a homeowner, landowner, apartment owner goes bankrupt, the company that is taking care of your apartment is going to lose business, right? So they don't want to do that. So this is another positive in real estate, is that you get to create actual jobs in the economy. When you're a real estate investor, that's a true entrepreneur because uh, when you're a stock market investor, it's good because you get to invest in companies, but you're not actually creating any real value in the world. You're kind of just investing in it passively. When you're a real estate investor, you're actually creating true value in the world because you're not only providing housing for people, but you're also giving the banks more money because then they can give out more loans to people that want to buy houses, right? They can give out more loans to people who want to buy cars or whatever they want to buy. And you're also creating jobs in the area by helping these companies have business because I mean somebody's got to take care of the apartments, somebody's got to come and do maintenance, they got to do lawn care. So when you're a real estate investor, that's how you're actually creating jobs and you're improving the economy, at least in your localized region, right? Another thing I want to talk about is the government versus the private sector, right? So like I just said, I just talked about how as a real estate investor, you're creating better services and products and everything, and you're creating jobs in the region. But a lot of times there's always a budding between the government and private sector. And I do believe that the government and private sector each have their roles to play in the economy, right? The government's role is to make sure that it's the well-being of everybody, right? Every single person, whatever the government can do, whether it's national security, whether it's, keeping up the roads or whatever, uh, government jobs, public service jobs, it's their job to ensure the general welfare of the community. But the difference between the government and the private sector, like I said, is the government does not have competition, which means that there's only one government. For example, if it's the United States government, the United States government does not have competition within the United States in order for products and services to be better and better, right? So for example, if it's a government job, like for example, the DMV, I believe it's by state, there's only usually one DMV. They're not competing between each other. So a lot of times the DMV, that's why the lines are really long. That's why it takes a long time to walk in the DMV and get something done because there's not competition between two or three different entities. For example, the private sector, though, if I'm a real estate investor within a certain town or within a certain country or whatever, I'm competing against all the other investors that are creating housing, that are creating all these things in community. So I have to make sure my apartment is the best it can be and provides the best amenities at the best price, or else the people that are looking for these apartments are going to go, these tenants are going to go somewhere else. I mean, we do this every day. When I moved to where I am now, I try to look at which apartment is in the best place, the best area in town, with the best prices, with all the amenities I wanted, you know. And we do this every day when we search for products, even when we go to the store, when we do services like lawn care, whatever, we're trying to find the best company that can give us the best services and products at the best rate. So that's something that I believe is, is a downfall of the government, that the government, or not the downfall, but a pitfall, that the government cannot compete with the private sector. And that's why I think that a real estate investor can capitalize on this and provide the best services and products for the people in the town. So, like I said, this is something that I hope to do in the future. Right? And like I said, a lot of times the government acknowledges that it can't do everything that the private sector can, right? The government cannot provide housing as good as the private sector can. The government cannot provide oil drilling as best as the private sector can, because there's all these oil companies that are trying to get the best, do it most efficiently, and which, remember, when the companies do something more efficiently, that also reduces the prices for the people buying those services and products, right? That's why a lot of times the government housing, even though it's cheap, it's low quality, right? So a lot of times the government actually wants people to provide housing and do all these amenities, which is why they give tax breaks for business owners. A lot of these things are tax credits for things the government wants done, which is why as a real estate investor, you get to claim depreciation, amortization, appreciation on your property. And like I said, this is kind of accounting as well. And as you guys have seen, my first three videos, when I actually did the full financial analysis breakdown, I've been improving, I believe, on each video. So go ahead and look at my first, second, and third video to see how I break down the credit rating of these companies, which has a lot to do with the cash flows and the balance sheets of the companies. But yeah, a lot of times the government will give tax breaks for businesses because these, instead of, like, for example, investing in the stock market is very passive, as I said, you get certain tax breaks such as preferred dividend rate, right? Because the government acknowledges that you're still investing in a big business, but when you're actually the business that's creating these jobs, the government gives you tax breaks as well. So obviously, this is another incentive for me to take my knowledge from the stock market and move it into being a business owner or being a real estate investor, right? I also want to talk about one other thing I totally forgot about, which is that banks and the government actually wants you to take on loans to start a business. Okay, so this is a very, very large misconception that people have, which is that, oh, if a real estate investor gets rich, that means that he's sucking money out of the other people in order to get rich. That's not true, actually, because if you understand how fractional reserve lending works, a lot of times when a bank gives a real estate investor a loan, there's actually no cash or anything sitting behind the bank, like behind the bank's counter or on the bank's ledger or balance sheet. Banks usually make loans off of other loans, off of deposits. So, for example, if I deposit $100 into the bank can lend 90% of that $100 and keep 10% in reserves, right? So the bank will lend out $90 to somebody who, let's say, wants a car. Well, that person will go buy a car for $90. Let's just say $90, keep it simple. And the person who sold him the car will take that $90 and put it back in the bank, right? Now the bank has another $90 where it can lend $81 of that. That new $90 came from that $100, and just like that, off that $100 is going to lend, um, it's going to become $81, and then the 81 is going to go out. People are going to put that in the bank, and the bank is going to be able to lend off of that. So if you truly understand how business works, banks and the government wants you to take on debt to do projects because, as let's say, as a real estate investor, I go and take on debt for my building, right? Well, what I'm doing is I'm actually essentially creating like $900,000, like in my previous example that I gave. I'm basically creating $900,000 out of thin air, which now goes into the economy, right? So that's another reason why a lot of times debt is actually tax-free money. But I do have to pay the debt back with interest, of course, but I'm not taxed on the debt like I would be if I was working for it. So, for example, if I was working for $1 million in order to pay cash for the building, um, the $1 million that uh, for the apartment complex, if I make $1 million, I would have actually had to make about 1.5 million probably, or 2 million, and then after tax I'd be left over with 1 million. The government, see, but if you take on a loan for 900,000, the government's not going to tax you for the 900,000 of income that you get from the loan because it's not income. You're getting the loan to invest it in the property, which then is going to create jobs, is then going to create more money in the economy circulating, right? So that's another reason why a lot of times big business owners are vilified or they're kind of frowned upon for being so rich, huge businesses. But in reality, a lot of times these businesses are creating the dollars and system that me and you are working for right now. So that's another reason why I hope to also get into real estate in the future. All right. And finally, I've thought about this, a little bit, but after I'm dead, um, I do want all of this to be in a trust. I don't want it to, be spent recklessly because I want this company, I want to create an entity where after I'm dead, this entity is going to continue to create the best products and services for the people, whether it's real estate or whether it's financial products or whether it's, whatever I decide to get into in the financial sense or in business sense. I want this entity to continue to provide products and services, and the better and better, more and more competition there is, the better and better the apartments are going to get. Um, so that's another thing that I've thought about after I'm dead. I want to talk about something really important um, that I've been thinking about the last few weeks and months. Right? It's great to have retirement accounts and to have IRAs and 401ks, and I'm not knocking anybody for doing that. I think that that's a great way to save, a great way to invest. But in a way, in my opinion, I actually think that having a 401k and IRA in a way is actually kind of selfish, and not in a bad way, but it's okay because when you invest in a 401k or IRA, you're not, like I said, providing any products and services back into the economy, back into the public. It's true that you are investing for yourself, but a lot of times what will happen is after you're done with the 401k or IRA, that'll be used for people to live on until they're dead or until they, pass on to the next generation. That money is not actually going back into the economy like it would be to the extent where, if you started a real estate entity or used debt or went to the bank for leverage. Um, so I'm not saying anybody's doing the wrong thing, but I'm just kind of laying out my vision here for what I want my business entity to be, which is why I'm, learning about the stock market, learning about companies, learning about how companies take on debt, how they use earnings to pay back, uh, interest and all that. So at some point, I do hope to have an entity holding company, and under the holding company, have different branches of, real estate or um, energy production, um, whether it's wind, solar, oil, whatever it is, maybe even a part of that for stock market, general investing and all that. So I hope to do this I hope to at least get into real estate within the next 1 to 2 years. But like I said, the whole point of this channel was to document my journey of learning as I continue my journey into different asset classes. So I really want to document it for you guys, but also for myself to look back on and see my growth. right? So like I said, guys, at the beginning of this video, I am really I'm starting to nibble into a company right now that I've done my own analysis on, but I will make an analysis for you guys as well. And this company is Applied Materials. Applied Materials is a company that is in semiconductors, right? So right now, your semiconductors are a pretty good growth industry for AI and all these new technologies that are coming out. If you really think about what these semiconductors do, they're going to be in cars, they're going to be in robotics, they're going to be in buildings for all the different sensors, moving parts. I believe that these semiconductors are computers, right? Phones, smartphones have chips in them. So this is going to really take over, whether you like it or not. It's going to happen. So I've done my full cash flow analysis on Applied Materials. Right? Applied Materials right now is currently trading for $96.51 a share. It's got a PE ratio of 12.91 and a dividend yield of 1.08. I believe this was a few weeks ago, though. 1 week ago when I took the screenshot, yeah, it says September 9th. I believe right now it's actually trading under 90, the higher dividend yield and a lower PE ratio. So I'm most probably going to add more this week and next week as I see it dip down lower because the yield is also increased, right? Like I said, guys, I really hope to do my analysis soon. I know it's been quite a while since I made a video. I've been busy, like I said. I am a financial analyst, so I have my normal job. But like I said, guys, I hope to honestly get this analysis done, and I hope to have this video for you guys next week on Applied Materials. I'm going to break down under what price I'm buying it. I hope to break down the future earnings of this company, how much investors can expect to get paid back in dividends over a 10-year period, 5 to 10 year period, 20 year. I'm going to break down all the time horizons. I'm going to predict where I believe this stock price is going to go the next 10 to 20 years. I'm going to break it down, like I said, 5 year, 10 year, 20 year horizon. I'm going to break down where, at what point I'm buying it under. And like I said, the stock price always follows earnings. So I'm going to be doing a deep dive into earnings and free cash flow. And of course, I'm going to also analyze the balance sheet and credit strength of this company. So I hope you guys can join me for that. Let me look at the date today. The date today is September 17th, Saturday, September 17th. So a week from now would be, I believe, the 24th is a Saturday. I hope to have it done and I hope to have it posted the 24th, 25th. So please stay tuned, guys, if you want to learn more about. It's going to be back to my financial analysis next week. I'm sure you guys will enjoy it. And please leave a comment if you're interested in commenting. Uh, Give me suggestions if you guys would like to see more videos like the one I just made today on just general topics going on right now, or if you want to see more financial breakdowns, if you want to see a video on, I don't know, uh, live stock market, right? Like if you guys want to see me react um, to inflation data coming out live, I can do that too. Let me know. And yes, have a great rest of your weekend, guys. Bye.